Target date funds are everywhere for American retirees, advertised as an easy one-stop shop. And in some cases, that might be true, but recent research shows that the average target date fund is much worse than you might think. So we'll break down all the details today and share with you how to judge whether your own target date fund is good, bad, or outright ugly.
Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 137. My name is Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. By night, I write the Best Interest blog and I host this podcast. I also put out a weekly email newsletter, and all of those projects help busy professionals and retirees avoid mistakes and grow their wealth by simplifying their investing, taxes, and retirement planning. And yes, today will be a deep dive, you could even call it an expose on target date funds. So first though, let me do a quick review of the week. This one is from 0302 Explorer, who left a 5-star review on Apple Podcasts and said, "Honest broker, Jesse puts out some great retirement and personal finance content that covers some issues that other producers lack. I particularly appreciated how he tackled projecting inflation and HSA, that's health savings account, issues. He's relatable, factual, and responds to emails. Thank you for the kind words, Explorer. And yes, I do love responding to your emails. If you've ever gotten a 300-word email response from me, I apologize for the length. I think sometimes writing a long easier is probably easier than writing a short one. It's like Pascal said, I would have written a shorter letter, but I didn't have the time. But anyway, Explorer, thank you for the kind words. Drop me an email to jesse@bestinterest.blog, and I'll send you a super soft t-shirt. And I know I'm a little behind on t-shirts. I have to get a couple months worth of t-shirts shipped out. So if you're waiting on a t-shirt from me, don't worry. It's on the to-do list. It'll happen soon. But let's get to the main show today. Let's focus on target date funds. I want to give a special shout out to a couple other retirement nerds who set me down this path for this episode. So Frank Vasquez, especially his episode 333 of his podcast Risk Parity Radio. Then Ben Felix and Cameron Passmore, and specifically their episode 374 of Rational Reminder podcast. They produce the Rational Reminder podcast. And then Professor David C. Brown, who conducted a lot of the research that I'll be citing today. We'll link to all the relevant research and podcast episodes here in today's show notes. The simple fact, and I'm kind of excited about this topic today. I'm excited to be talking about it because up until, a couple months ago, I had this one particular set of thoughts about target date funds, very positive thoughts. And those thoughts were based on all the learning that I'd done over the past 12 years. Everything that I've ever consumed and whatever of those topics were based about target date funds left a very positive set of thoughts in my head about target date funds. And if you look at other experts out there, Ramit Sethi or Christine Benz or John Bogle himself are all on the record saying some pretty good things about target date funds. And when they said those things in the past, especially if they were referring to what I'll call the right type of target date funds, I think those experts had a totally valid point. Somewhere in the filing cabinet of my mind, that helped me shape my positive opinion about target date funds. But with new information and new research, I had to shake off my prior opinions about target date funds and revisit them. And so that's what created today's episode. So in today's episode, I'll explain to you what target date funds are and how they work, just how dominant they are in the American retirement landscape, which is one of the reasons why I think it's so important to talk about them. We'll talk about the glide path concept, which is fundamental to target date funds. And I'll explain these 5 key factors of target date fund performance and why those 5 key factors often lead to underperformance, which is one of the main reasons why we're here today. I'll talk about this thing called the curse of average and what you might want to think about instead of a target date fund and kind of what the spectrum of investing looks like. On that topic, I will talk a little bit about bread. Yes, the food, but I promise you, bread has something in common with target date funds. And last, I'll share with you a couple examples of target date funds that I think are the best of the bunch, and I'll share with you the exact criteria that I use to evaluate them. So let's get going. A target date fund is a type of investment fund designed ideally to simplify your retirement investing. Instead of building and managing a portfolio yourself of many different funds, you choose a single fund labeled with a year that's close to your expected retirement date, such as a 2045 fund or a 2060 fund. And the fund itself then automatically manages your investment mix over time. And the core feature of a target date fund is its glide path. Think of a plane coming into land, a glide path. And that glide path determines how the portfolio's risk level changes as the investor ages. Early in an investor's career, the target date fund typically holds mostly stocks because younger investors have many years before retirement and they can tolerate more market volatility. But as the target date itself approaches, the fund gradually shifts toward bonds in an effort to reduce the impact of large market downturns near retirement. Most target date funds are structured as a fund of funds. And what I'm about to say here is an incredibly important set of details, okay? Very, very important. So instead of the fund holding individual securities directly, target date funds usually invest in a collection of underlying mutual funds or index funds, so that the target date fund manager decides how much to allocate to each asset class, such as US stocks or international stocks or bonds, and then periodically rebalances the target date fund portfolio to maintain the intended allocation. So it's a very important set of detail that it's a fund of funds, and we'll dive into those details much further today. Now, if we combine the glide path idea with the fund of funds idea, I want to give you a quick example of how a particular target date fund works. So I'm going to share the Vanguard family of target date funds, as they've published a very informative webpage explaining their glide path in great detail. We'll link that glide path link here in the show notes. So Vanguard, for all their target date funds, they define 5 age-based markers in a person's life or career. So at age 20, they assume that someone is starting the early career phase of their life. And then at 40, the second phase starts. They call it mid-career. At age 60, they define that as the beginning of the transition to retirement. Age 65 is when retirement actually occurs. And then at age 72 is what they call the beginning of retirement withdrawals. And that's based on research that they've done. They said the average retiree begins withdrawing from their portfolio at age 72. Going back, starting at age 20, Vanguard has its investors in a 90% stock, 10% bond asset mix. The stocks themselves are a 60-40 mix of US to international, and the bond portion is 70% US to 30% international. And that 90-10 overall allocation remains until age 40. And that's when, for Vanguard, the glide path begins. So over the following 20 years, between ages 40 and age 60, the allocation shifts from 90% stocks down to 60% stocks, and from 10% bonds up to 40% bonds. That glide path continues on to age 65, by which time the overall allocation is 50-50. But in the 5 years between 60 and 65, the Vanguard funds, they add in short-term TIPS. TIPS being, Treasury inflation protected securities. It's a type of bond that's protected against inflation or has a hedge against inflation. And about 10% of the portfolio ends up in TIPS by age 65. So 40% being other types of bonds, 10% TIPS, and 50% in stocks by age 65. And then the glide path continues another 7 years to age 72, which, as I said before, that's when Vanguard's research states is the average age when portfolio withdrawals actually begin. And at that point, the Vanguard target date fund, it reaches its final allocation, 30% stocks and 70% bonds. 16 of that 70% is in the TIPS bonds. And that allocation is maintained going forward for ostensibly the rest of the investor's life. So that right there is how a glide path works. Now, let me pivot really quickly, talk a little bit about history. Back in the early 2000s, we have to understand that the default investment in many American retirement plans was cash, or very, very short-term treasuries. After all, cash and treasuries are both very, quote-unquote, safe, low-risk investments. So rather than automatically investing someone's money into something slightly more aggressive or something that had more long-term growth, the 401k plans back in the early 2000s and before would play it safe with an ultra-low-risk asset. So you would have people who were saving in their 401ks for years, if not decades, and maybe they assumed their money was being invested in some way, but unless they went in and actually maybe opted into a true investment, that money might just be sitting there in cash, again, for years or decades. And that's not a very good outcome. In fact, it's an outright bad outcome. But Congress changed things. In 2006, they passed a law called the Pension Protection Act. It took me about 5 takes to get through that word, which basically mandated that every single retirement plan out there have these things called qualified default investment alternatives, QDIA, qualified default investment alternative. And as the name might imply, the point was that you can't just put all the people in the 401k plan in cash as a default. You have to have some sort of actual investment alternative that can act as a default. And target date funds were one of the very limited options that qualified as one of these QDIA, qualified default investment alternatives. And their appeal was their ease. Investors could hold one diversified fund possibly for decades and decades of time, while the asset allocation automatically adjusted as retirement approached. And this idea, at least on its face, makes sense. It aims to provide a hands-off, a diversified, a long-term investment strategy, all good things, and all related to an investor's expected retirement timeline. Now, Morningstar, well-respected institution, estimates that almost $5 trillion today sits inside of target date funds. If you had 100 million people, right? Think about that. If you had 100 million people who each had $50,000 inside of a target date fund, that would get you to $5 trillion. I only put it in those terms because 100 million people is about 2/3 of the American workforce, or about 40% of the entire population of American adults. And $50,000, while not enough to retire on, is a pretty good chunk of change. And I would wager that any of you listening, for example, that you would care and you would certainly keep track of a $50,000 line item on your balance sheet. So the magnitude of what we're talking about here today is as if half the adults you know have $50,000 on the line. It's kind of a big deal. And then approximately 2/3 of all new dollars going into workplace retirement plans are going into target date funds. So again, it's as if more than half of all the working people you know are putting their retirement dollars into these types of funds. It's a big deal. And I can say for myself that currently my 401k is through Empower, which is a really big kind of 401k institution. Now, I'm not using a target date fund in my current 401k. I built a simple 3 index fund portfolio in that account. But at my previous 401k, I was using a target date fund. It happened to be a BlackRock fund, and we'll come back to BlackRock later today. And I know for a fact that the reason I got interested in personal finance and investing in the very first place is because my first ever post-college job, I was using a 2050 target date fund through Fidelity, and I was watching it grow. So target date funds are everywhere. But not all target date funds are equal. In fact, many of them are not only less than optimal, many of them are outright bad. And that's one of the big reasons why I'm here talking to you today. So why do I say this? Now, what's the simple summary takeaway for today's episode? It's that the average target date fund in today's American retirement plan underperforms by an average of 1% per year. Underperforms by an average of 1% per year. Don't worry, I'll explain this. But the takeaway is that 1% per year underperformance. If someone starts using a target date fund at 22 and holds it until 82, after all, it is supposed to be a one-stop shop for life, that could be 60 years of underperformance. If you punch that into a calculator, if you punch in 1% underperformance for 60 years, it would eliminate 44% of that investor's would-be wealth. Instead of having $1 million, that investor only has $560,000. Now, that is obviously a tremendous claim. It needs to be explained. It needs to be backed up. But the first and most obvious place to start, I think, is a 1% underperformance. Well, compared to what? You know, what benchmark are we using to say that target date funds underperform something? And this result comes directly from Professor David C. Brown's research. What Professor Brown did was he looked across the target date fund landscape at any one particular vintage. So a vintage, almost like wine, think of the year. So 2040 target date funds, 2040 being a particular vintage. He's looking across every single 2040 target date fund. He looks at Vanguard's 2040. He looks at Fidelity's 2040 funds, because Fidelity actually has 2 different 2040 funds. One is totally passive with index funds, but one is active. One uses active funds at Fidelity. And he looks at BlackRock's 2040 and State Street's 2040 and T. Rowe Price's 2040, et cetera, et cetera, et cetera, every single 2040 fund out there. And he takes the average allocation of all of them. How much in U.S. stock, how much in international stocks, how much in U.S. bonds, international bonds, and other stuff. That average allocation to stocks and bonds and other stuffs, that's the study's benchmark. But more specifically, the study benchmark portfolio uses only index funds. So again, the 2040 benchmark against which all of the individual 2040 target date funds would be compared was simply the average allocation of all those funds in terms of stocks and bonds and anything else, but recreated as a totally passive index-only fund. Then Professor Brown went through and compared each individual 2040 fund against that benchmark. And on average, the individual 2040 funds underperformed this benchmark by 1% per year. Now, where does that underperformance come from? Well, the first place is fees. On average, 0.55% or 55 basis points, right? Just over 0.5%. 55 basis points of the underperformance is due to fees alone. Because remember, the benchmark portfolio, it's only index funds, so it's very, very low cost. Professor Brown used Vanguard index funds specifically. So his benchmark portfolio had fees lower than 0.05%, 1/20%, 5 basis points. And what this is telling you, in short, is that many target date funds have fees that are 0.5%, 0.6%, 0.7%, or even higher. Some fund providers charge upward of 1.2%, or upward of 1.5% per year. That's just for the investments, and that's just not a good price in today's investment landscape. And I'm not saying that target date funds should be free. I'm not saying that it should have the same cost as an index fund. But these products can be done so simply that the fees ought to be very, very low. Vanguard's 2040 fund, for example, has an all-in cost of 0.08%, 8 basis points, 0.08%. Fidelity's Index 2040 fund is 0.12%, or 12 basis points. Now that, to me, is the cost I would expect to pay for a target date fund. So fees are the biggest component of the underperformance. But where else does the underperformance come from? The next biggest culprit is actively managed funds inside of the target date funds. So even before we look at fees, the active funds that are inside of some target date funds underperform their comparable indexes by about 0.45%, or 45 basis points per year. So let's go back to the Vanguard 2040 fund to explain this one. Vanguard's 2040 fund has 4 sub-funds inside of it: a U.S. stock index fund, an international stock index fund, a U.S. bond index fund, and an international bond index fund. All 4 of those are index funds, very, very cheap. But not all target date funds are composed of only index funds. In fact, many are not composed of any index funds. I'm going to pick on Fidelity a little bit here because I know they're big enough to handle it. They do offer an index target date fund, like I mentioned before, but they also offer active target date funds. Their 2040 active target date fund, the ticker is FFFFX. That's 4 Fs and then an X if you're curious. It holds 15 U.S. stock funds, all of which are Fidelity funds and all of which are active. It also holds 10 international stock funds, all Fidelity, all active, 15 different bond funds, and a smattering of individual bonds too. It's a lot. It's also all relatively high cost because it's actively managed and there are more people at Fidelity working behind the scenes to manage that account, manage that fund, I should say, and that's expensive. Fidelity is far from alone here, and in Fidelity's defense, that particular 2040 active target date fund has performed right in line with Fidelity's own index target date fund over the past decade. But the fact is that many other fund providers also offer target date funds that hold their own active funds, only playing with their own active funds. And just what do we know about active funds in general? Well, we know that on average, they underperform their passive counterparts. You know, it reminds me of the culinary stories about how a cook can use a bunch of old, possibly bad food and blend it together into a soup. That's not the soup that you want. But what we have here are fund managers, many of whom you've heard of, who blend together their active funds into target date soup. And they know that target date soup is an approved investment type. It's an approved food item inside of the 401k and 403b plans. And they know that 2/3 of all new dollars going into retirement funds order some form of target date soup. To me, this is a very bad problem. Those are the 2 biggest culprits of underperformance here today. Target date funds provide worse performance simply due to their often active management, and they do so at much higher fees than passive funds. Worse performance plus higher fees equals 1% per year underperformance. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. Now, I said there are going to be 5 negative components of target date funds, and we've only covered 2. The third one, the next one, is what they call tactical allocation changes. So let's use Vanguard as our example. Back in the mid-2010s, Vanguard's target date fund managers decided, on the whole, that all of their target date funds didn't have enough stock exposure, and so every single one of their target date funds shifted higher in their stock allocation. That was a strategic long-term shift over their entire target date portfolio. Now, any fund manager is welcome to do the same kind of thing. Or they can say something like, you know what, normally we'd be 60-40 US to international on our stocks, but we're going to shift to 70-30. Or we feel like interest rates are going to drop, so we're going to overweight our fund into bonds. These are active tactical decisions that the fund managers make at some sort of high allocation level, and they are essentially either changing the predetermined glide path or they are chasing returns or predicting returns in some way. And these decisions, on average, reduced the returns of target date funds by about 10 basis points or 0.1% per year. That's the third big issue with target date funds, is that sometimes you have managers who are trying to be smart. I'm sure they're not trying to hurt investors, obviously. But on the whole, when those fund managers do something like that, they do end up hurting investors. The fourth issue, I guess the more I think about it, you can make an argument that the fourth issue I'm about to say is just a symptom of the first three issues, but the fourth issue is the amazingly wide dispersion between different target date funds. In Professor Brown's study, he found that the annual rate of return difference between the best target date funds and the worst target date funds of the same vintage, meaning, the same, say, 2040 target year, that the best versus the worst funds had an annualized return difference that was 3% per year. And the most egregious quarterly dispersion, so in a single quarter, was a full 23%, meaning during one particular quarter, Fund A might have returned positive 5%, and Fund B returned negative 18%. Now, admittedly, Professor Brown would admit this is a cherry-picked statistic, but just imagine two investors who believe they are invested in basically the same thing. After all, they both own a 2040 target date fund. One investor, though, sees his portfolio go up by 5% in a given quarter, and another investor sees hers go down by 18% in that same quarter. Or another way of looking at it is that over the next 20 or 30 years, their annualized returns end up differing by 3% per year. That's a massive difference. Now, what happens when one investor gets, say, 5% a year for 30 years, and another investor gets 7% a year for 30 years? With typical 401k annual contributions, the difference in their two returns is easily going to surpass $500,000. I mean, that's what we're talking about here, is the differences of $500,000 between two investors who think they are invested in basically the same thing. And the point is that for a fund type that, at least to me, is marketed like a commodity, it's anything but a commodity. And now what do I mean by that? I mean that all gasoline, as far as most of us know, is basically the same. It's a commodity. Sugar and table salt and white rice are basically always the same across brands. Milk and eggs and baby carrots are basically the same across different brands. And that, at least to me, is how target date funds are at least marketed to us. But what this study shows, and what we're here to talk about today, is that that's not how it works in reality. A much better analogy, equally as ubiquitous as gasoline or baby carrots, would be the common hamburger. Yes, every hamburger involves a beef patty between a bun, but every restaurant, from the fast food juggernauts down to the local diners to the Michelin star, gourmet restaurants, they all do hamburgers their own different way. And to suggest that all hamburgers are the same, while yes, they share some common traits, they are far from identical. And so that's why my fourth major drawback here is the dispersion in results. For something that is marketed, at least to the layperson, as being largely uniform, the results make us realize it's anything but. And fifth is what I would describe as the illusion of choice. So yes, Vanguard and BlackRock and Fidelity, at least on the index side, and some other providers do have some really good best-in-class target date funds. But does your 401k or 403b have those ones? Maybe not. Most retirement plans only have one single family or one single fund provider of target date funds. And as I mentioned earlier, my very first 401k plan only had Fidelity target date funds. I don't exactly remember if it was the active or the index kind. I don't own it anymore. My previous employer had only the BlackRock target date funds. And I look at people's account statements all the time. I've seen many of the target date fund providers that make up the bad results that we've covered here today. So even though, as we'll discuss in a few minutes, there are some target date funds that I believe are on the good side of this conversation, there's a stronger likelihood that any individual person out there is going to have one of the limited target date fund options in their retirement plan that's on the bad side. Those target date funds aren't very good. Let me now slightly pivot to something called the curse of average. Some people see this curse as a total failure of target date funds. I see it as a smaller issue than that, but an issue nonetheless. So the curse of average is an idea that designing any product, right, whether it's an investing product or a consumer product, an educational product, anything, that designing it for the average user is just a flawed design strategy, because an average person who perfectly represents the average in all dimension, well, they rarely, if ever, exist. So when you design for the average, you create a product that ends up being mediocre for everybody rather than truly helpful for any one person. In other words, how could Vanguard or any other fund manager design one fund that is supposed to be quote unquote right for everybody between ages 43 and 48? How could they possibly take into account that person's savings rate, if they reach retirement different from age 65, or if they begin withdrawing different from age 72? How can they take into account the outside investment accounts or how those accounts are invested? How can they take into account this person's guaranteed income in retirement, like Social Security or pensions, their withdrawal needs in retirement, their human capital and their future earnings potential, their need, ability, and willingness to take on risk? I mean, the list just goes on and on. And I think one possible viewpoint here is, well, then the product that tries to answer these questions and tries to be this average product, it should never, ever exist in the first place. It's got a million holes in it, and the curse of average is so glaring that nobody should ever put money into a target date fund. I understand where that argument comes from. I'm not quite so severe on it. Instead, my take on it is something I'm going to steal from the words of John Bogle himself. He said, target date funds are not a panacea, which, if you're like me and found the SAT reading section a little hard, a panacea is a solution or remedy for all difficulties or diseases. And Bogle is saying that a target date fund is not a panacea. In other words, it's got flaws. It's not perfect. But in the right situations, it is different than saying it's, outright terrible. It's never going to be perfect, but it also doesn't have to be terrible. Imagine this as an example. We've got a 45-year-old person who's just discovered this world of personal finance and investing for the very first time. This person is literally at square one. They're eager and ready to learn. They've got some money saved in various accounts. And, well, it is invested really poorly, even if they don't know it yet. There's no cohesive investment strategy or financial plan that kind of defines what they're doing with their money. They just have, 50 different ticker symbols of just random funds. And if that person decides on day one of their new financial planning beginnings, and if they decide to invest in a reasonable target date fund based on their future retirement date, I think that's a step in the right direction. It's way better than what they've been doing before. Is it their set and forget solution for the next 30 years? No way. But is it good enough for the next year or two while they read some books and some blogs and catch up on some, maybe they catch up on some podcasts? Yes, I believe that a good target date fund is the perfect kind of holding pattern while that person tries to figure things out. That's the curse of average. And that's the reason why target date funds are likely never going to be perfectly designed for you in particular. But I don't think we need to throw out the baby with the bathwater. That's just my 2 cents. Pivoting now to an important question. What should you do instead of investing in a cruddy target date fund, assuming that's what you've been doing in your retirement account? So going back to the Vanguard funds we discussed before, there were 5 unique investment classes inside of Vanguard's funds, right? U.S. stocks, international stocks, U.S. bonds, international bonds, and then those TIPS, inflation-protected bonds. And you might be tempted to recreate or build your own target date fund using individual index funds in your 401k, 5 individual index funds representing those 5 asset classes. Well, I think that's a little bit overkill, actually. And I'm also just willing to bet that most of you will not have access to all 5 of those asset classes in your 401k or 403b. But most retirement plans today do offer some index funds. There have been enough lawsuits over retirement plan fees such that low-fee index funds are now usually part of the investment menu. So at a bare minimum, if you're going to try to recreate your own target date fund, it's really helpful if you have access to just the following 2 funds: a total U.S. stock market index fund and a total U.S. bond market index fund. Now, coming in as a really nice third place would be a total international stock market index fund, or combining number 1 and number 3 would be a total world stock market index fund, including every country, including the USA. Now, if you don't have a total US index nor a total world index, but you do have an S&P 500 or other large cap US index fund, that's a fine substitute. The S&P 500 captures something like 3/4 of the US market and about half of the global market. So if that's all you have access to, well, that'll do. There are good arguments both for and against investing in international bonds. And then this is speaking as an American retiree, as an American investor. Now, I don't see a particularly large need to do so. And there are many good arguments for and against investing in inflation-protected bonds, TIPS. I don't think you really need them, in my opinion. But if you have access to the world of stocks via a passive index fund, and at least to U.S. bonds via a passive index fund, and that access comes at really, really low fees, which it ought to because these are index funds, then you're golden. You can now create this specific asset allocation specific to you, to your financial plan, and that allocation will hopefully mirror some of what you're doing, or at least take into account some of what you're already doing in your other accounts that you own. Now, why am I keeping it so simple? Well, I'm doing this a little out of order, but I'm going to quickly read from a recent article I wrote, because if you understand bread, yes, the food bread, you can better understand investing, and specifically this target date fund or simple investing strategy that we're talking about today. Because at its most basic level, bread contains 4 core ingredients, and each one serves this specific role in the chemistry and the structure of the loaf of bread. Flour provides structure. There are these proteins in flour that combine with water to form gluten, and gluten is the stretchy network that traps gas bubbles and allows bread to rise. Water is the second ingredient. Water hydrates the flour, activates gluten formation. Yeast is next. Yeast leavens the bread and makes it rise. And then salt. Salt is the fourth ingredient, controlling the fermentation of the yeast, improving the flavor of the bread. Without salt, bread is usually flat. The dough can become sticky and weak. And those are the core 4: flour, water, yeast, and salt. And granted, many people do add more ingredients, maybe some sugar or honey for flavor to feed the yeast. Some fat, like butter, oil, or dairy, for tenderness and richness. Eggs can also add richness and some structure. Whole grains or seeds can add some flavor and nutrition. The point is that bread is not complex. Each ingredient, though, has an important role to play. And what's the point? Why am I talking to you about bread? Well, 1, it's simple. There aren't dozens of ingredients. 2, every ingredient has a specific job, a specific domain, a reason why it's there in the recipe. And largely, those jobs don't overlap with one another. And then 3, in varying proportions, though, those very few unique ingredients can create many, many different outcomes in bread, right? You can reduce the flour and add water, add seeds, reduce this. You can just play around with the core 4 ingredients, or you can play around with the core 4 plus a couple more ingredients in different proportions and create many different types of bread. I was thinking about this because I was looking at a prospective client's portfolio, and it was constructed using a 10 to 20% allocation of each of the following 8 Vanguard funds. So VTI, which is the total U.S. stock market, VOO, which is an S&P 500 fund, VV, which is a large cap fund, VUG, which is a growth stock fund, MGK, which is a mega cap growth fund, VGT, information sector fund, QQQM, which is a NASDAQ 100 fund, and then VO, which is a mid-cap ETF. And some of you might think, well, those are all different descriptions, right? Growth versus information versus mega cap, S&P 500 versus NASDAQ. They're different. It seems like each fund is probably providing some different diversification to this person, but that's not the case. This is a portfolio of various wrappers, but all of those wrappers are basically holding the same stocks. If instead I put this portfolio in bread terms, it's as if their recipe called for 2 cups of bread flour, 1 cup of all-purpose flour, 1 cup of high gluten flour, half a cup of pizza flour, a 1/4 cup of premium organic white flour, no water, no yeast, no salt, no sweetener, just flour. And that's not good bread. And what I just read to you wasn't a good portfolio. I would much rather advocate for a portfolio where every quote unquote ingredient has a clear job and just one job. We don't need 100 ingredients. We don't need too many ingredients doing the same thing. Any portfolio, but especially a retirement portfolio, I think needs 4 vital distinct ingredients. The first one is appropriate risk level. Your stocks versus bonds versus other assets mix matters far more than which specific funds you pick. This asset allocation decision should be related to how much money you need from the portfolio and when you need it. It needs to be part of the financial plan. It needs to be related to the financial plan. So that's the first ingredient, is appropriate risk level. The second ingredient is broad diversification. You want to avoid concentrated bets. You want to avoid stock picking. You want to avoid redundant funds that own the same companies. A retirement portfolio should resemble the entire market. And you don't have to, and maybe it's not always a smart thing to do, but you can accomplish this with one single fund. Often, though, a few funds leads to better results, perhaps akin to baking bread from just one pre-made box recipe versus combining the ingredients yourself. So that's the second one, is broad diversification. The third ingredient, low costs. I don't think there's really much of an explanation needed there. And then the fourth ingredient is behavior you can stick with. Your portfolio should be simple enough that you can understand it, tolerate it during crashes, stick with it for decades. Now, if you need some flavor in your portfolio to make it more tolerable behaviorally, so be it. Some people, they need cinnamon and raisins in their bread, and some investors feel like they need an allocation to gold. They need to own some Costco stock. They need to have exposure specifically to the aerospace sector. Okay, I can live with it as long as that makes you not jump off the ride, as long as it's, in relatively small proportions. Again, think about bread. It's one thing to say half a cup of raisins in an entire loaf. It's a different thing to say 3 cups of raisins per loaf. As long as it's done tastefully, in small amounts, I understand why people sometimes need to add some flavors to their portfolio to ensure that it's a portfolio that they can stick with for the long run. So again, the takeaway from this bread idea is to know your ingredients and know why you're using them. And most investors, I think, will make it more complex than it really needs to be. Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. Back to our regularly scheduled program about target date funds. Of those 4 key ingredients, which again were appropriate risk level, broad diversification, low costs, and behavior you can stick with, I think we figured out today that many target date funds are too broad and too average to pinpoint the appropriate risk level for you specifically. So good on average maybe, but not good specifically when it comes to risk level. And in some cases, the costs of the target date fund are far from being low. As far as risk level and low costs, different target date funds simply don't meet muster there. But I think that many target date funds do provide broad diversification, and actually they are fantastic behaviorally. One of the double-edged swords of convincing people that target date funds are a one-stop shop is that target date funds have some of the lowest amount of investor turnover of any funds in existence. In other words, people really do buy and hold and hold and hold their target date funds. Now, I think you can and should aim to create your own portfolio such that it does hit a risk level appropriate for your financial plan and that the costs are really low. If that happens to be through a target date fund, okay, and we'll talk about that in a few minutes, but oftentimes it isn't. So before I dive into a couple target date funds that I think meet muster, let me first explain to you my criteria for evaluating these target date funds. Again, first was fees. Lower is certainly better. And as those fees start to slide up from, say, 0.1% to 0.15% to 0.2% or higher, I'm just asking the question, why? Why am I paying for a target date fund that has a fee of 0.5% per year when Vanguard or Fidelity or BlackRock are selling me an index passive-based target date fund that's 0.1%? That's 1/5 the cost of 0.5%. So fees are very important. My second criteria was passive management. This goes hand in hand with fees. But as we spoke about earlier, 2 major causes of this target date fund underperformance are both the fees themselves, which will always have a drag on performance, but also the choice to go active, which even before fees are counted, the active management led to an average of 45 basis points of underperformance. So passive matters a lot, at least to me. Third, I consider any sort of an exotic investment inside of a target date fund to be more negative than positive. If a target date fund, for example, has real estate exposure or commodities exposure or anything like that, I do think we're overcomplicating it. And now, what I didn't do at all was grade the glide path itself. And the reason why is because if we're trying to grade the curse of average glide path over a 60-year investing timeline, I'm really not even sure how to begin. I think everyone would probably fail if we're doing that. Even though I didn't grade these funds on the glide path, I will comment on it in a few minutes. Now, a few different research papers cite between 50 and 60 unique fund families out there in the American retirement landscape. Again, Vanguard is one family. Fidelity has 2 different families, passive and active. BlackRock has 1 family. So there's 60 different families of target date funds out there. I did not look at all 60, but I did look at the top 5 because the top 5 families of target date funds own over 80% of the target date fund market. They are, in order, Vanguard at 37%, Fidelity at 14%, T. Rowe Price at 11%, BlackRock at 10%, and American Funds Capital Group at 8%. In short, Vanguard is best. Great on fees, fully passive. On the exotic investments axis, I know some investors might stick up their nose at international bonds and TIPS, which are both in Vanguard's target date funds. Fair enough, but I've seen far worse sins. There is a spectrum to investing here, and having international bonds and TIPS isn't that bad on that spectrum. But anyway, Vanguard is best. Next for me is BlackRock and their Life Path series of target date funds. Again, great on fees, fully passive. They too have a small exposure to TIPS. They also have an exposure to real estate investment trusts or REITs. One interesting note is that BlackRock's LifePath series starts at almost 100% stocks for investors in their early 20s and then decays down to only 20% stocks by the time an investor is 85 years old. So that's just an interesting glide path there. Next in line for me is Fidelity, a little Jekyll, a little Hyde, because their Freedom Index series, the passive series, Freedom Index, it's a great family of funds, but their actively managed Freedom series is, well, actively managed. I also think it's a little challenging that one is called Freedom Index and the other one is just called Freedom. It can be a little confusing. The passive family has fees of 12 basis points, excellent, while the active series costs between 50 and 75 basis points. The passive series is everything that we want investing-wise. The active series has some serious flavor to it, and I believe it's just not needed. And that brings us to a tie for last between T. Rowe Price and American Funds Capital Group. Can you guess why? Well, it's because they're all high fee and all actively managed funds. The fees are in that 50 to 60 basis point range, and the portfolios have lots of expensive exposures to these small corners of the market, with the target date fund portfolio managers having discretion over when to jump in and out of funds, when to overweight or underweight different parts of the portfolio, et cetera, et cetera. All that behavior that decade after decade becomes more and more clear to us that it sounds good in theory. You know, it sounds good to have someone smart who is making lots of changes that they think will be helpful to us, but that research shows decade after decade, on average, is detrimental to the end investor in practice. The more active management, the worse the fund is likely to perform. T. Rowe Price and American Fund Capital Group are two easy and apparently quite popular examples of target date funds where I would highly recommend looking for a better alternative. And again, when it comes to, Vanguard, BlackRock, and Fidelity's passive funds, I still don't think you should lean on these funds as your forever solution to investing. I don't think that makes sense for anybody. And the reason, again, is the curse of average. It's the glide path problem. The idea that these target date fund providers have gotten your particular risk exposure correct for a 60-year period, or even a 10-year period, probably not. So instead, if you need a place to park your money while you figure everything out, if you don't have any other really good options inside your 401k except for a Vanguard target date fund, then fine. By all means, that's where these passively managed, low-cost target date funds can make sense. They're never going to be perfect, but they certainly can be good enough. So today we discussed what target date funds are and how they work. I hope you realize how significant they are in the American retirement landscape, with many people in your life likely having big sums of money in these target date funds. We talked about glide paths and how the one-size-fits-all might lead to more problems than solutions. Mainly, though, we focused on the average underperformance of target date funds, which tend to underperform by more than 1% per year when compared to a very similar portfolio of pure index funds. We talked a little about bread, about how a few simple independent ingredients in the right proportions can lead to many different recipes, successful recipes, and quote-unquote correct recipes. And last, we talked about how if you're unsure whether your retirement plan has a good or a bad target date fund, how you can make some judgments for yourself. I really hope this episode was helpful, maybe even eye-opening. It certainly was eye-opening for me. So thank you for listening. Let me know what you thought of this episode. Thank you for subscribing, for writing in with your questions and comments. Thank you for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.